Good evening. Welcome to IG's special coverage this evening of the interest rate decision from the Federal Reserve. It's normally at 7 o'clock in the evening, of course, but because of the time difference in the States 2 weeks ago, we got a clock moving this weekend when we get back to that 5-hour time difference between London and the eastern seaboard of the United States. The New York Stock Exchange, of course, at the moment now just 4 hours adrift. So we've got this 6 o'clock release and we are looking for some interesting headlines to come out of it, in as much as we are pretty much sure that the Fed is going to move by 25 basis points. Let's take a look at the what the Federal Funds Futures was telling us a little bit earlier on in the day. An 84.1% chance of an interest rate rise of a margin of 25 basis points. Now that would take the target rate up to 4.5 to 4.75%. Now, the other option is that we've got a 15% chance, or around about that, of no move at all. Now, one of the no move at all camps is what we've got from Goldman Sachs. Now, Goldman Sachs earlier today said that the historical record suggests that the FOMC tends to avoid tightening monetary policy in times of financial stress. The big question is, are we in times of financial stress, or is this just a small retracement in what is otherwise a market that is looking as though possibly it could well cope with the what's going on in the banking sector? And the Goldman Sachs statement goes on to say it prefers to wait until the extent of the problem becomes clear. Well, that is certainly a fair point, because monetary policy takes a long while to coalesce and make itself felt in the market. And it's more than likely that Goldman Sachs says that the Fed will make sure that it's confident that other policy tools will successfully contain financial stability risks. Now, what the point of that statement is that Goldman Sachs is suggesting that basically the moves in the market at the moment are doing the Fed's work for it, and that we will see no move in interest rates. Let's turn to Axel Rudolph, IG's chief technical analyst. We'll look at the charts in just a minute, but the message is, I think, that we've got this idea that as I said, the Fed's work is done for it. Or do we go with 84% of the market plus, we're looking for a 25 basis point rate rise?
Well, as you say, Jeremy, I think the recent stress we've seen in the financial markets and the fact that banks will want to look at their balance sheets and shore these up instead of lending money out to the greater economy means that in a way the work's already been done for them. Tightening is already happening. And this has been exacerbated by the banking crisis over the last few weeks. So I wouldn't be surprised if the Fed doesn't hike rates today for that reason.
It's interesting, actually. I made an error. I should say it's between 4.25% and 5%. But the economic projections, we're going to get details of that coming through from the statement today. And we'll get a better idea as to how the Fed's thinking about the outlook. What are we doing in terms of us traders on the markets? What are you looking at?
Well, with regards to euro-dollar, for example, what I'm looking at is whether we can rise above the mid-February high at 108.04, because that was my last technical resistance level to be taken out for the bulls to be back in control, because in that case we will have formed a nice bullish reversal signal here. And that could mean that euro-dollar could head back up again towards the 110 mark that we saw earlier in February. So further dollar weakness being seen in the weeks to come. Now, if we were to fail here, if the Fed were to surprise and perhaps do something that no one expects, rise rates by 50 basis points, for example, then we probably would see quite a lot of strength coming back into the US dollar and euro dollar coming off. But that is really not expected by anyone at the moment.
When you get this dollar weakness, this is what this chart is showing us. We look at gold naturally, and gold has been a fairly good play, hasn't it?
It certainly has, because if you look at the price of gold, and that's gone up to a one-year high at $2,009 per troy ounce on the back of these problems with the three regional banks in the US going bankrupt, and also Credit Suisse being bought up by UBS. So the banking crisis has led to a sharp rise in the price of gold. Now that the banking crisis seems to abate a bit, the gold price is coming off again. So it'll be interesting to see whether that will continue after today's announcement by the Fed or not.
Okay, all right. Back with Axel in just a few moments' time. Let me go back to my chart. I want to turn this into a chart which gives us the reaction in the markets to a 1 minute chart, so we get an idea as to how traders are moving the markets in the wake of the news, which we are expecting any moment now. We are expecting this interest rate rise by a margin of 25 basis points. And as I said, the Goldman Sachs point is here, is that we are moving in a market which is able, and it's done exactly what we are expecting at 25 basis point climb in interest rates. So the interesting thing about central banks, and we heard from Chris Bailey from Financial Orbit earlier on today, he says basically it's boring. It's well signposted. The market pretty much knows what to expect, and that's exactly what we got. He said boring in as much as basically we're being told in advance as to what's happening. This was exactly the same with the budget this week or last week. It was exactly the same, and it will be the same tomorrow with the Bank of England. The Federal Reserve was expecting to move by 25 basis points. It's done exactly that. This has been the market reaction, interestingly, but I think if you look back at a daily chart, you can see this move in some sort of context. It is obviously pushing us up to new highs today, and in fact we're pretty much the top of the candle, which indicates to me that there aren't many sellers in this market at the moment. So Axel, clearly it is a trade where the bulls on the euro dollar trade are beginning to win out. I guess the next question is where now, based on the technicals?
Well, as I just said, this level 108.04 for me is really important. If we close above there today on a New York closing basis, then I believe we will see further upside. After all, we've seen 5 consecutive days of higher levels for euro dollar, and that could translate to it rising all the way back up again towards the 110 area, and basically we could even retest the February high at 110.33 and go above it.
Let me just take a look as well. If you can go back to my chart, I want to go on a 1 minute chart for the S&P 500. I just want to quickly read through some of these headlines. The vote spread indicated that it was on the verge of pausing further interest rate rises in borrowing costs amid recent turmoil in the financial markets. This rate now stands at 4.75 and between 4.75 and 5%, with updated projections showing 10 of the 18 Fed policymakers still expect rates to rise another 0.25 percentage point by the end of this year. And this is the same endpoint seen in the December projection, so that's not changed anything. But I think one of the interesting points to mention here, there's been a key shift driven by the sudden failures this month of Silicon Valley Bank. Axel was alluding to the banking failure. Signature Bank, the Fed's latest policy statement, no longer says that ongoing increases in interest rates will likely be appropriate. That seems like that language had been in every policy statement since March the 16th last year, and that has now been taken out. Instead, the policy setting FOMC said only that some additional policy firming may be appropriate. So it's gone back into somewhat weaker language, leaving the open the chance that one more percentage point increase in interest rates could well be coming down the pipe, perhaps at the Fed's next meeting, and that would represent at least an initial stopping off point for the interest rate rising cycle. And as we said earlier on, this is a situation where clearly the Fed's language has changed. It's clearly been brought into play because of what's happened in the banking sector, and there's this delay, isn't there, in monetary policy. The Fed's got to wait to see just how much damage, which is effectively what's going to be done now to the economy, with all that's built up and the fact they've got interest rate rises they've undertaken, which still haven't really had the full effect. And it'll be interesting to see just if there is now a recession, if there is a recession, how deep it's going to be, how long it's going to last, and then what the Fed response is by the end of the year. And we're hearing from some people that we could end up seeing an interest rate cut by the Fed. I don't know whether you think the statement brings that any closer.
Well, it certainly looks like it. I mean, at least they have the optionality of going down that route if they have to. And of course, inflation is coming off in the US, so maybe that's less of a concern now going forward. And as you say, these monetary policy hikes in the interest rate in the US have a lagging effect on the economy. So we'll have to see whether in the next few months we'll see more layoffs in the States, for example, and whether the Fed will then try to avoid a hard landing, yeah, and still can pull off a soft landing, which looks less likely, I believe.
What about the S&P 500? What are your thoughts there on your chart?
Well, again, very technically interesting because we are breaking through the February to March downtrend line. And if we can close above there today, then for me, that's a valid trend line break. And we're also trading above the 55-day simple moving average. And all of that together with the fact that we're now trading back above not just the 200-day simple moving average at 3,933, but also the psychological 4,000 mark in the S&P, means that we could basically head back up again towards the early March high, which was around 4,078. So for me, that actually looks quite bullish, this price action.
Yeah, just getting some more headlines coming through. There were no dissents on the policy decision. This is the voting members of the FOMC. They all decided to go with this market move that we've seen. But as I said earlier on, the commentary would seem to indicate that some had been thinking about no move at all in interest rates, which represents that 15% we were talking about when the Fed Fund futures, the markets were pricing in what was expected this evening. But of course, this, I think, really does bring to an abrupt end, or close to an end, of what's happening with the Federal Reserve. Just wanted to go back to the 1 minute chart as we can on the S&P 500 before we take another look at what's happening with gold, because gold is, as we said, an interesting play in all this. As we got money going into these risk markets, because I think that it looks like the Fed is beginning to, as I say, take its foot right off the pedal. And we'll have to see what happens at the next meeting. But we've got a news conference, of course, at the bottom of the hour at 6:30 p.m. UK time, where we'll get some more detail about what's going on. What about gold, Axel?
Well, gold, Jeremy, is very interesting because it's also going up. So that's quite an inverse.
I think we can bring up Axel's chart. There we go. That's your chart there.
So yes, gold is actually going up. It's not coming off.
But that would go well nicely with the weakness in the dollar still.
That is probably why it's going up. So the interesting point here will be whether we can rise back up again towards this week's high at 2009. Because if that were to be overcome, then I think the next upside target is the all-time high around $2,070 per troy ounce, which was made back in March of last year. So from a technical perspective, short term it looks as if those who are long gold could stay long as long as they have a stop loss in place, for example, below today's low around $1,934 per troy ounce.
Yeah. Let's go back to the markets. I've got the Dow Industrials here, actually. It's the same sort of story as Axel was talking about here, this push higher at the moment. I think it's interesting, actually, Axel, there's one other headline I wanted to talk about, because this goes in, I think, some way to look at the potential of a soft landing. Job gains are robust, according to the Fed today. Officials projected the unemployment rate will end the year at 4.5%. Now, that, I think 4.6% was what we saw in December going into January. So that is actually holding up nicely. And it shows that the economy, despite the fact we've got this slowdown, almost sort of an engineered slowdown, which the Fed will take some credit for because they moved fast on interest rates. They haven't looked like they've gone overboard. And certainly at today's meeting, it looks like they are sensitive to some of the market pressures. But I think if we can maintain a fairly solid jobs market, that's an excellent landing, isn't it, for the economy?
You say if, and that's my worry, because basically the labour market is a lagging indicator, and it takes time for monetary policy to filter through into the labour market. So I personally wouldn't be surprised if we see further layoffs, especially in the tech industry, and that then also leading to lower wages, and at the end of the day, to also a weaker economy and perhaps not a soft landing. So that is the risk here, really.
Okay, as you were talking, I've got the Nasdaq up here, talking about tech stocks. Let me just draw a line across there. You can see actually now, we are now meeting the highs that we saw in this candle here back on the 2nd of February. We haven't yet, I don't think, beaten that 12,895. Yes, we have. We've got a new higher high here for the Nasdaq. Now, the Nasdaq has been an outperformer on the US markets on the Dow, on Wall Street. We've now got levels on the Nasdaq not seen since the 26th of August 2022. I had a guest in the studio here today talking about the banking crisis and the effects of all that. The Nasdaq has been one of the markets where we've seen this outperformance on the upside. I'm not quite sure why techs have taken this so well. Yeah, they're laying off staff. I guess that's probably good news for corporate balance sheets.
That's probably the reason why, as simple as that, yes.
Yeah, so interesting. Nasdaq, with this break of the 12,895, the next line of resistance then starts to peak at 13,215. So it's an interesting play with these tech stocks. I guess it's just a question of waiting now to find out what happens. And of course, when looking out from this point, we've got the Bank of England tomorrow. I'm not quite sure what this means to the Bank of England, if indeed the BOE takes anything away from this. Very different picture, of course, in the UK with this strong inflation number this morning. Yes,
no, definitely. And 10.4% in February, much higher than the 9.9% we were expecting. And I agree. I think the Bank of England will be forced to hike its rate probably to 4.25%, so another 25 basis point rate hike in the pipeline there, just to bring inflation down, because it's far more sticky in the UK than it is in the US.
Yeah, looking at my chart here for sterling against the US dollar, are you as equally bullish on sterling against the dollar as you are on the euro against the dollar? Or, I mean, the UK economy is in a very different position. It doesn't seem to be able to control inflation. However much of that comes in from abroad, of course, oil prices amongst other things, but the oil's on the way down now. But is sterling a trade where you think perhaps maybe, let's go back to Axel's charts. He's got his chart there showing that trend, that channel that we've got.
Yes, I mean, for me, cable's still looking quite bullish here. As you can see, we continue to rise, and we are trading well above the 200-day simple moving average, now also above the 55-day simple moving average. And we are testing and trying to close above the high seen in mid-February at 122.70. So for me today, if we were to close above there, on a New York closing basis, I believe further upside is in store, and that could take us back up again towards the highs seen back in December of last year and also in January of this year between 124.46 and 48. So unless we reverse lower, which I can't see happening from a technical perspective right now, and fall through the 120 area, further upside seems to be in place.
Yeah. Okay. Axel, thanks so much indeed. Axel Rudolph. You can catch up with him on Twitter and indeed across the IG platform, where Axel writes a lot about the markets and technical analysis. Thanks indeed for your time this evening. Just want to quickly recap. The Fed delivers a small interest rate rise as the market was expecting, and say some additional tightening may still yet be possible this year, and they're now looking possibly at interest rate cuts come 2024. I will be back at 7:30 tomorrow morning with Thursday's early morning call, where I'll be looking ahead to that Bank of England decision at midday tomorrow. Good evening.